Simply Financial with Christopher Calandra, Certified Financial Planner, is an innovative, comprehensive, informative, and cutting-edge podcast that discusses financial topics ranging from personal finance, economics, politics, and personal growth. Simply Financial will cover intriguing and thought-provoking questions so that the listener can simply increase their financial IQ.
Welcome to the Simply Financial podcast. I'm your host, Christopher Calandra. Thanks for joining me today. This is episode number 12, season number 3. On today's episode of the Simply Financial podcast, I have a very special guest. I have with me today Peter Hugg. He is the Director of Global Trade for Kitco Metals. He has been involved in the precious metals industry since 1974. He is a frequent speaker at precious metals conferences and in the financial media. He speaks to thousands of viewers each week on Kitco News, drawing on his years of frontline experience to provide a trader's perspective on the market. So it's a real treat to have him on. I got a great outline. I'm really looking forward to picking his brain on a number of topics related to gold and silver. So, Peter, thank you so much for taking a few minutes out of your busy day to talk with me.
It's a pleasure to be here, Chris.
So it was kind of, at least for me, a long-winded background. Did I cover your background okay?
Yeah, you certainly did. I came out of university in '73 in Toronto, and I cut my teeth in the foreign exchange business. And about 2 or 3 years later, I was hired by a bank that wanted to engage in precious metals, and we were fortunate enough to catch the gold rush of '79-80 and developed one of the largest trading operations for precious metals in Canada through the '80s and early '90s.
Very good. And so just to catch listeners up, your title, Director of Global Trade, you do that for a company called Kitco Metals, but could you just give a summary description on what a Director of Global Trade does or what you do as Director of Global Trade?
Well, as an overview, I run the trading operations for Kitco North America as well as our office in Hong Kong. So when clients buy or sell precious metals from us, it creates a liability on Kitco's books. If a client buys metals, the company needs to cover that trade. And if clients sell us metals, we're long the metals, we need to hedge that trade as well. So my job is to maximize the profit and at the same time manage the risk of trading in precious metals and the foreign exchange that's attached to it. We have reach not only in North America but all through Europe and the Far East. So many of our clients do not trade in dollars. They trade in euros or in pounds or in Japanese yen. So there's a foreign exchange component to our transactions as well that needs to be hedged. So that's my job primarily, and beyond that, I represent Kitco at various conferences and in views of the market, but I also develop new products for the company as I see fit.
Very good. So I was thinking that Director of Global Trade sounded awfully impressive, but it sounds like it actually doesn't sound like that. That is pretty impressive. So I wanted to ask, I want to get your thoughts on gold in the short, medium, and long term. But first, can you give us your opinion on why investors should own gold?
Okay, so let me premise that answer by stating that, I don't believe gold is an end-all, be-all investment. I mean, gold has a place in a portfolio. Sometimes the weighting of gold in the portfolio is going to be greater. Sometimes it's going to be cut back depending on the circumstances of where we are in the economic cycles, supply-demand issues, potential geopolitical issues. So I think there is a place for precious metals in a balanced portfolio. So if your audience is looking for me to say, the world is coming to an end and gold is going to go to $10,000 an ounce, I'm just not in that camp.
Okay.
I think that there are a variety of serious risks on the horizon. One being the equity markets in the U.S., which I think are top-heavy at current levels, the issues with Brexit in Europe, the issues with some of the Italian banks, the issues with the slowdown in the European Eurozone. Mario Draghi, the president of the EU, came out this morning and basically postponed raising or tightening their credit policies at least until the end of 2019. They're concerned about growth. There's issues with China and the U.S. with the trade war. So there's a number of macro factors in the market that suggest that the other investments that you may have in your portfolio may be subject to increased volatility in 2019. And in that context, gold tends to be a relatively secure hedge to protect your portfolio in times of anticipated increased volatility.
Okay, so you think, and this is your opinion, and let's just acknowledge, you and I, that we're not giving individual advice. Nobody should go out and act just on anything you and I are talking about. That's crazy. But generally speaking, in a diversified investment strategy, your opinion is that there's a place for gold at all times, but that allocation may increase or decrease based on general market circumstances. Is that right?
Correct. I mean, it would be the same context if you had a balanced portfolio of stocks, bonds, for example. And again, depending on your age group, your risk tolerance, you have, the equity markets that run up 200%. It might be prudent to pare back some of that weighting in the equity side and maybe increase your bond weighting. So, it's a matter of managing your portfolio. And what people tend to do, investors tend to do, and this tends to be sort of a negative way to invest in gold, they either go to a conference or they hear somebody that indicates the world is coming to an end, and they load up on gold, and they just buy it and they forget about it. And gold, to me, is no different than Apple stock. You need to balance your portfolio on a consistent basis, minimum at least once every 6 months. So, and then you need to look at the psychology of why you're making the investment. Are you making the investment from a capital gains perspective, or are you making the investment from a perspective of an insurance policy for the balance of your portfolio? So let's assume you're making it from the perspective of an insurance policy. You want some protection against the overall volatility of the balance of your portfolio, which consists of bonds, stocks, real estate, whatever comprises your portfolio. And you go in with the mindset that you want a 10% weighting in your portfolio of gold. And that weighting could be in the form of physical gold bars, it could be in the form of ETFs, could be in the form of gold mining shares, but you want a 10% weighting. You can't just buy the 10% and then forget about it. You need to manage that in the context of your entire portfolio. So just to give you sort of a real simple mathematical type of example, let's assume you bought gold in 2008 when gold was trading at about $600 an ounce, and in 2011 gold was at $1,900 an ounce. I can almost guarantee you that your 10% weighting, if that was your psychology, was probably now worth 19 or 25% of your portfolio.
Right.
So you need to pare that back to stay within that 10% weighting. And the same holds true the other way. If you would have bought gold at $1,900 in 2011 because you believed it was going to the moon, and then in 2012 gold was sitting down closer to 1,400, and then went down all the way to about 1,060 in 2015, your weighting in gold was probably not 10%, it was probably now at 3%. So you need to add 7% to get back to 10. Now, when you do that, you then have a correlation of 10% of your portfolio in gold, but you tend to exit the market on gold strength, and you add to your position on gold weakness with the intent of always being at a 10% weighting.
No, I think that is great, and my practice, Elliott Wealth Management Services, as a certified financial planner, Peter, is that we do rebalance, big believers in rebalancing, and you're talking about a specific allocation that should be rebalanced. I did an episode back in season number 2 of the podcast. It was episode number 5 of season 2. It was titled Portfolio Rebalancing in Today's Market. So I fundamentally agree with the idea of rebalancing, not just for gold, but you could go back, and you've been in the business a long time like I have. You could go back to similar instance at the 2000s when tech stocks ran up so strongly that if you didn't rebalance, you got really, really hurt with the tech wreck that happened in 2000, 2001. And you could take the same approach with what happened in the financial crisis when stocks ran up prior to the crisis. If you didn't do some rebalancing to other more conservative non-equity investments, you would have been harder hit in the financial crisis. So I agree completely. You mentioned a few things I was hoping we could unpack for our listeners that may not be terribly familiar with how can you invest in gold. So you described a few ways. You can do paper version, things like ETFs, like GLD, I think is the most popular symbol. That's basically gold without the O. That's the symbol. It's an ETF, and correct me if I'm wrong, Peter. That's a proxy on the price of an ounce of gold. It's a paper asset. That's one rather easy way that you could participate in gold. Here's what I'm thinking about. That's a good way to invest in gold, but you don't physically own the gold. But it does allow you to more easily own it in retirement accounts like IRAs, Roth IRAs. So is that one of the key features of investing in the ETF, the paper asset version of gold, where you don't physically own the gold, but that also allows you to own it in retirement accounts? Is that a good way to look at it?
Well, again, I would make the argument that you own the gold the same way you would own Apple stock. Basically, it's an ETF is backed by physical gold. At least that's what it's supposed to be. It's audited. Many people don't believe the gold backing ETFs is actually there, but that's a different mindset of investor. But buying an ETF in gold, like when you buy Apple stock, Apple stock is not issued and segregated into your account. You're holding it on a seg basis in the broker's overall portfolio of Apple stock. So an ETF in gold is similar. The ETF is backed by gold. There are charges on the ETF. They work out to about a little over 1% per annum. So it's sort of similar to a mutual fund on an MER basis, but it's relatively easy to trade it. Again, from an IRA perspective, you can hold it in your IRA in the format of an ETF, but you can also hold physical gold in an IRA. You're allowed under U.S. law to buy a 10-ounce gold bar and have it delivered to your custodian, your trustee, who then holds that 10-ounce gold bar in your IRA account for you. So you could also buy physical gold in an IRA. IRAs are not limited just to equity transactions or ETFs.
That's a good point, Peter. But is it fair to say that in that second instance, not all custodians are set up to accommodate such a position in an IRA? A lot of mainstream ones like Pershing, Fidelity, Schwab, well, I don't think they could do the physical gold part of the IRA. You do need a special custodian. Is that fair?
Well, I think they can do it. It's the question of whether they want to offer the service. I mean,
gotcha.
Somebody like a Gold Star tends to be one of the bigger ones in the U.S. that aggressively markets precious metals for IRA investments in the physical format. But there are a number of trust companies and trustees that offer their clients the ability of holding gold in an IRA.
All right.
Now, the other firms may not find it profitable enough to get into the physical